Hi, I'm Dan Danford. We're doing a series of podcasts for DadsDivorce.com looking at financial issues. This week's issue is on interest rates, and we get a lot of conversation, a lot of question about interest rates. They're big news items all the time, but people kind of scratch their head about how it affects them. As a matter of fact, our question from a viewer this week, everyone keeps talking about interest rates, but I'm not sure why I care. I mean, other than the rate on my credit card and car loan, what does it matter? How does all that talk help me? It's a great question. This gets a lot of attention in the media, and I know a lot of people scratch their heads and say, I just don't get it. How does that change anything for me? Interest rates in general are a couple of observations that are kind of interesting. One is, in some ways, interest rates are more complicated than the stock market. Now, it doesn't seem that way, but I can tell you, I worked for a number of banks over the years, and banks deal in interest rates all the time. I worked with some really high-powered executives, and they were forever trying to predict whether interest rates might go up 0.5% or down 0.5%, and I never found anybody who could predict it every time with any kind of accuracy. It seems like it ought to be easy to predict, but it's not that easy to predict. And probably, so as an individual, it's more complicated than it probably looks. And yet, interest rates are important for our economy, and they create a lot of opportunities and a lot of challenges for people. And that's why they get the attention that they get. Things like mortgage rates, car loans, credit card rates are responsive to changes in interest rates, and they can make a big difference in our personal finances. So let's just look at a couple of things that are really important about interest rates. One way to look at interest rates is that they are rent on money. Essentially, I have money that's left over after I pay my bills and all that kind of stuff, and I'm willing to loan that money to somebody else, and they will pay me rent for the use of the money. Okay, so that's the interest rate that I'm charging someone. Same way when I want to buy a new car and I don't have enough money to buy that new car. I might go to either the car dealership, or I might go to a bank or a credit union, and essentially they have extra money that they're willing to let me use for some rent payment. So it's real easy to just think of this as the people who have money that they can set aside and loan to other people or renting it to them. On the other hand, people who need money can go someplace and they can rent that money for their needs. So it's real interesting. It's just like having an extra house or renting an extra house. It's the same kind of concept. Now, why is it important? From a personal finance standpoint, the use of debt is called leverage. And leverage is kind of magic in the world. As a matter of fact, for most of us, most families, the place where they use leverage, the one and only place where they use leverage, is on their real estate loans when they buy a house. What they're doing there is they basically put some money down on the house out of their own pocket, but then they borrow the money from somebody else for the rest of the purchase price of the house. They're levering up that money. They're using their 20% and 80% of somebody else's money. Over time, you pay down that mortgage, the value of your real estate grows, you pay off the house someday, or you sell it and you move someplace else, and your returns in that real estate have been magnified because you used other people's money to help you accomplish that purchase. Businesses do this all the time. If businesses have extra money and extra resources, or they want to use their money and get the most out of it, maybe they will buy real estate and put some money down, or buy equipment and put some money down, but they're basically borrowing other people's money to cover a big chunk of it, and because they're able to use that resource, whatever it is, to make profits, they can add to their bottom line over time. Now, people don't face the same opportunities as businesses. For most of us, that mortgage is the key thing that we can leverage in our financial situation, but it's very, very important. So it's a tool. Debt is a tool. Borrowing is a tool that can help your financial situation. Now, it's also important to throw a caution in there too, is that if you're over leveraged, it can really have consequences when tough times come along. And that's what we're seeing today. When times were good, people borrowed a lot of money on their houses, probably more money than they should have on their houses. And then when tough times come along and they lose their job or their hours are cut back or whatever, they don't have enough money to pay the interest and principal on those loans. They're over leveraged and they end up being foreclosed on. It's true in the world that probably many of the great fortunes of the world have been created through the use of leverage, but it's also true that most bankruptcies probably come from the bad use of leverage. So how you use debt, how you apply those interest rates is very, very important. Now here's the interesting thing today. Because of our economic situation, because of actions by the federal government and the Federal Reserve Board and the SEC, interest rates that count are very, very low. My wife and I bought our first house back in 1981. When we bought that house, I think our first interest rate was over 10.5%. Okay? We just refinanced the house we live in today and we got a rate that was less than 5%, 4 5/8, I believe. Half the rate of what it was when we started out our married life many years ago. It is the lowest interest rate we have seen on mortgages in our lifetime, and I think there's a fair chance it may be the lowest we see as we go forward. So it's a real opportunity for people who are in a good position to borrow. That can make a tremendous difference in your financial situation as you go forward. Lower interest rates don't always translate into lower rates on everything. Your credit card rates probably haven't dropped a lot. A lot of those are tied to LIBOR or other interest rate indexes. They don't drop as quickly as, say, mortgage rates or other things. Car loans, same thing. Interesting, one of my daughters had to buy a new car. The dealership offered her a loan. It was like, I want to say 10.5 or 11%. I called one of our local bankers, and for the same car, the same terms, everything, we were able to finance that loan at less than 5%. Now, it may not seem like a lot, but let me tell you, over a 4 or 5 year car loan, it makes a tremendous difference what the rate is. And if you can slash that rate, then you can really save money. Now, the reason I tell that story is because, again, we're at a real unique time. Interest rates are lower on some things today than they have been in decades, and it's a good time to take advantage of that. Now, while low interest rates are great for borrowers, they aren't so good for lenders. So if your parents or grandparents, say, are investing money in the bank, instead of having mutual funds or money market funds or whatever, they buy CDs at the bank. The rates they're getting at the bank aren't that great today. As a matter of fact, I've seen a lot of bank accounts and a lot of CD rates that are in the 1%, 2%, and 3% range. If you get a 3% CD today, that's awfully good, and you have to tie up your money for a long time. So while low interest rates are good for borrowers, they aren't so great for savers. Most people that we deal with, when we're talking about family investments and we're helping people who are young get through situations, they tend to be more lenders than savers. Okay, so today's environment favors young families who are kind of getting started or people who are starting out their financial lives and looking forward to the future. Now, let's go back to our question for a second. Everyone keeps talking about interest rates, but I'm not sure why I care. I mean, other than the rate on my credit card and car loan, what does it matter? How does all this talk help me? Well, it's just a good time to take care of things regarding borrowing. If you've got consumer loans, furniture loans, car loans, even house loans, now's a really good time to see if you can't refinance those things. These rates are much lower than they've been any time in the last 5 or 10 years. So if you've got outstanding debt on those kinds of things, go out and check. Call the bank, call the furniture dealer, call the car dealers, check with your credit union. See if you can refinance those debts at a lot lower than they were before. It'll save you money in the long run. It'll put you on the right foot as you go forward. Credit cards, not going to help you very much on credit cards. The best advice on credit cards is get rid of them. So if you can use, even if you can take, I hate to say consolidate debts, but if you can take money that you get from a mortgage or a car loan or something like that and apply it to your credit cards, you will reduce the interest rates you're paying, and it'll put you dollars ahead. Now the key is don't fill up the credit cards again with a bunch of consumer purchases, because you'll be right back in the same position 6 months from now. All right, that's the brief course on interest rates and debt today. Next week we're going to be talking about what to do in this bad economy so that you can survive it as you go forward in the future.